In this recording, I will cover three topics, and they are connected. ROIC, which is return on invested capital. WACC, weighted average cost of capital. And economic value added. So let me start out with the conceptually how they come together. Return on invested capital, ROIC, and weighted average cost of capital are two components that help us assess how much economic value is being added by the management team. Now, what does that mean? The ROIC is basically the performance of the company, and I'll talk more about that. But it's really a performance of the company, how well they are performing. Weighted average cost of capital is how much is costing the company to get the money to be able to invest in the business. So obviously, you want to be able to generate more return than is costing the company, so you would want the ROIC to be higher than weighted average cost of capital, and if it is, then the management team is adding economic value. So what I will do is I'm going to start out by talking about ROIC, then I'll talk about WACC, the weighted average cost of capital, and then connect them together in the end. So let's talk about the ROIC, which is return on invested capital, right? Now, it is a ratio. I think there are other ratios that you're familiar with in finance. And this is ratios associated with combination of profitability and the assets. And some of the ratios that you're familiar with is, like return on assets, which is net income divided by total assets, or return on equity, which is net income divided by total equity, return on sales, also, referred as profit margin. So it is net income divided by total sales. ROIC is return on invested capital. So what is invested capital? Invested capital obviously comes through looking at it from the balance sheet perspective. So every company will have an income statement and a balance sheet. So this is just an example of it. Income statement, you have sales, you'll have cost of goods sold, and then you have some other expenses like research and development, selling and general administration, and then you kind of do a subtotal. It's called the earnings before interest and taxes, also called operating income. Then we have interest expense, for the loan that we have, the interest we are paying that gets to profit before taxes. Then we pay income taxes and gives a net income. So this is really basically an income statement. The balance sheet has assets, starting with the current assets, cash, inventory, accounts receivable, and so on. Long-term assets, that gets us to the total assets, short-term and the long-term. Then on the debt side, you have notes payable, accounts payable, accrued expenses. So the current liabilities, some total long-term liabilities, and the total liabilities. And then you have the owner's equity, and sometimes you may also see treasury stock, that gives us the total equity. And so the total liability and total equity, $93 million in this case, obviously has to be equal to the total asset. That's why the balance sheet is balanced. Assets are equal to liability and equity. So we want to do is to start to kind of think about, hey, what are some of the ratios that we are familiar with, right? So if I take that information from the prior chart and kind of bring in the data we need to do some of the ratios that we are familiar with, sales, it was 147, net income was 5, total assets was 93, equity was 61. So from there we can calculate return on assets to be 5.38%. Return on equity is 8.2%, and return on profit is 3.4%. So ROIC provides a little bit more operational knowledge that can help us. So let's kind of look at that. So the ROIC measures how effectively is company returning the EBIT, also called operating profit, as a percent of total invested capital. Company borrows money, or company as investors investing money. Now the management team is taking that money and investing in the assets. Assets could be building, equipment, inventory, and those things are then used to generate profit and cash flow. So the question is how effectively it is being managed. The formula is that you take EBIT, or the operating profit, times 1 minus tax rate, and divide that by invested capital. So the EBIT will come from the income statement, that is the earnings before interest and taxes. Tax rate, obviously we would know from the income statement. So let's talk about briefly what is invested capital. Invested capital is the dollar invested by shareholders or the investors or the stockholders who's publicly traded, and also the debtors, people that are lending money to the company. Now, when we're doing the calculation for invested capital, when looking at the return, we are only going to use interest-bearing debt because there are other debt on the balance sheet, like an accounts payable. Accounts payable is the money that the company owes the suppliers, but they're not paying any interest on it. There is no interest charges on it. A company may have an agreement with their suppliers to say, hey, we're going to pay you in next 30 days or next 45 days or next 60 days. So in the meantime, they owe money, but they don't have to pay till the terms are up. So anything that is non-interest bearing, like accounts payable and also accrued expenses that you're going to find on the balance sheet, there is no interest expenses associated with it. So when we do the invested capital, the debt portion will not include any non-interest bearing debt. So invested capital then becomes the total equity plus the total debt, but we subtract from it things that are not interest bearing, typically their accounts payable and accrued expenses. Okay, now, so the formula, as I mentioned, is ROIC is equal to earnings before interest and taxes minus 1 minus tax rate divided invested capital. And then, invested capital will become equity plus interest bearing debt. So let's look at the balance sheet that we had before and see if we can kind of use this to take and calculate a formula, right? So EBIT will come from here. We need that for the formula. Tax rate, we need that. And how do we do that? If you don't know it, we can look at it and say how much profit is before taxes and how much taxes we are paying. So from there, we can, figure out the income tax rate. So that will go over here. But, equity will come from the balance sheet. So that comes from there. Interest-bearing debt basically will come from the total debt, and we want to subtract from it anything that is not interest-bearing, like accounts payable and accrued expenses. We'll take that out. So now we can calculate the ROIC, the return on invested capital, which basically is that we take the EBIT, which is 10, times 1 minus tax rate, which is 44%, divided by invested capital, which is equity, which is 61 from the balance sheet. And then we add the debt, subtracting from the total debt is the non-interest bearing debt, which is accounts payable and accrued. And so we get a return on invested capital of 7.13%. So what that basically means is that the company is returning a return of 7.3% on the money that was invested, either by shareholders through equity or through debtors that they lend money, and obviously are charging an interest. So that's how you calculate the ROIC. Now, so if you are looking at it, obviously you want to look at the trend. So you want to look at the number of years. You can use the same formula, but you can look at the number of years. Let's say looking from year 1, 2, 3, 4. And so it is a good idea to see the trend. In this example, ROIC was, around 7% as we calculated. Then, here slightly less. It goes down, which means companies are not performing as well. And then year 4, it finally turns around. Now, so next thing we want to do is to talk about the second component we talked about for the economic value added, and that is weighted average cost of capital. So the weighted average cost of capital is the overall cost of capital for how the company has to either borrow or the investors to invest. And so the formula basically would include how much is it costing the company to get money from the investors, the shareholders, and the debtors. As the cost of borrowing from the debtors is different than the cost of equity, the working weighted average cost of capital is a weighted average. What does that mean? First, you're going to figure out what is the cost from the debtor, what is the cost from the equity holders, and then based on how much of the invested capital, what percent pro rata is debt, and how much it is from the equity, then we do the weighting average, and the formula will do that for us. So let's look at the formula. The formula is that we look at both components. First, we look at to see that how much is debt as a percent of total invested capital. Remember, we just talked about invested capital. What is invested capital? It is total equity plus debt, but we take out from the total debt any non-interest bearing debt. So debt is basically non-interest bearing debt. Total invested capital is interest bearing debt plus equity. We multiply that by cost of debt. RD is the cost of debt, and we're going to multiply that by 1 minus tax rate. So this piece over here that I've just talked about so far, that is going to be the portion of the weighted average cost of capital that is associated with the debt. The second part over here has to do with the equity. RE is the return that the investors are expecting. Then you multiply that by, again, how much is the equity divided by the total invested capital. Again, debt is only interest bearing, accounts payable, accrued interest, investments, expenses are not included. And RE is expected return expected by investors. And I'm going to show you how you calculate all this. Okay, again, we're going to go back to this example. The piece of the formula that I'm going to do first, again, weighted average cost of capital is both pieces, debt related and equity pieces. The highlighted piece over here is what we're going to talk about first. So here we need the interest amount, we need the tax rate. We talked about that before. It comes from here. We need to know the equity value. We need to know the interest-bearing debt. We talked about that before. We take the total debt, subtract the accounts payable and accrued expenses. So that gives us the total invested capital of equity, which is 61 million from the equity side. Total debt is 32. Subtract from it the 5 for accounts payable and 10 for accrued expenses. And so invested capital is IC is 78. So when we throw into the formula, one of the things we will need is this RD, which is the interest rate. So how do we figure that out? We look at the interest dollars that are in the income statement. So they're paying about $1 million, over here, and the debt they have, interest-bearing debt they have, is 17. And how do you do that? You take the 32, which is the total debt, but you subtract out the accrued expense and payable, which is non-interest bearing debt. That would bring it down to 32 minus 15 will bring it down to 17. So if they are paying 1,000 over 17,000, that would mean that their average interest cost is 5.8%, and that is the RD. So now we plug in this formula, the yellow piece of it over here. The yellow piece, total debt divided by total invested capital times rate of debt times 1 minus tax rate. We plug all this in and we get 0.712%. 0.712%. So that is the yellow shaded piece that we just calculated. Next we're going to do is to calculate the second piece, which has to do with the equity. Okay, now, so the equity piece, we need some information to do that. So what are the formulas? One of the formula we need to know is how we're going to calculate the RE, and I'm going to show you how to do that. We know the equity, how to do that. We already done it. It's over here, 61. We know total invested capital. So all that stuff, we already know how to do it, right? We talked about interest expense. We know the tax rate. All the stuff we know. So we've done all that. So what is the new stuff that we're going to do now is to look at the RE. RE is what the investors are expecting. And the formula is risk-free rate plus beta multiplied by market rate minus risk-free rate. The stuff in the parentheses is called, a risk premium. So what does that mean and how do we calculate it, right? So let's talk about that. Risk-free is really something that you basically are not, if you invest in it, you're not taking a big risk. So for example, if you invest in 10-year bond, when I'm doing this thing as I speak, in June 3rd, 2022, interest rates have gone up quite a bit. They used to be around 1.5, 1.6, 1.7% for 10 years. Lately, it's been up close to 3%, which typically, if you look at a 10-year and you kind of look at the average over many years, like 30, 40, 50 years, you're going to find 3+% to be a good average. So that's a good number to use. So we're going to use 3%. The beta is really specific to the company. Beta is really a measure of how volatile that particular stock is, or the company is, in terms of stock going up and down, but it's compared to how S&P 500 or the broader market is doing. So it is a measure of volatility versus the broader market S&P 500. If the beta is less than 1, volatility is less relative to S&P 500, which means that as S&P 500 may go up, say, 10%, beta less than 1 means that on average, it will go up less, similarly it will go down less. 1 basically means it's very, very similar to S&P 500 volatility. If the beta is more than 1, it is more volatile than S&P 500. So, again, today, June 2nd, today is Friday. As I looked at it on June 2nd, here are some examples. Facebook, now, the company is called Meta. Obviously, a lot going on lately. So you can see that beta is much higher than 1.37. Ford Motor Company, 1.15. Companies like Procter & Gamble, they're considered to be quote-unquote more defensive stocks in the sense that obviously things they sell, we all need them regardless of the, be recession or whatever. So typically you're going to find more of the defensive type company, not defense as a, as a military defense, but defensive in the sense that they're less economically affected up and down because the stuff they sell basically is we all need it regardless of how things are. So here example, 1.37, 1.5, and that's how you would get the beta. So what if the other thing we also need is the market, the RM in the formula. How do you do that? So RM basically is on an average, how much has the S&P 500, the broader market, has grown. So one way is to look at it. I basically looked at it, a little while ago, and I looked at it and said, okay, over the last almost 38 years, how much has it gone up? So if I go plug in the Excel right now, even though the market has come down in the last, a few weeks, even if I plug it right now, as when I was doing it today at 4108 S&P 500, and it was at 181, in December 1984, and approximately 38 years. So the average rate is 8.56%. What does that mean? Means that if I had put in $100 over here, on average, every year it would have gone up 8.56%. And obviously, every year is not going 8.5%. Some years it's going much higher, as you can tell. But on average, it has gone 8.56% every year. So this becomes the market rate. Okay, so it's about 8.56%, right? So now we know what the RM is, right? So let's say we assume the company has a beta of 1.2, right? We're going to use that to do the formula. So we're going to try to solve this for the calculation. Again, we got all this information, so we don't need all that. So I'm just going to continue to move along here for us. And now, what if we know the RM? We just looked at the 38 year period, so it's a long time. And it was growing at 8.56%, so I'll just call it 8.5%. So the RM is 8.5%. RF, as I talked about, is a 10-year bond. It's around 2.8% right now, so we can kind of call it a 3%. Let's say the beta for this company is 1.2. So I got the beta 1.2, RF is 3%, RM is 8.5%. So now if I plug it in, I'll get 9.6%. That means the expected return of capital, if the risk-free is about 3% and the beta is 1.2, the investor will expect 9.6%. Now, if I take this RE and also include the equity divided by total invested capital, if I do this over here, I get 7.51%. So what have we done? We had calculated the debt portion of it, which I had highlighted in yellow. Now we have calculated in the blue portion, which has to do with the equity. So now if we put it both together, again, the formula, as we talked about a few minutes earlier, is that the weighted average cost of capital includes the debt piece and the equity piece. And I shaded in yellow when I was doing it and did the blue in this one. Earlier we did it, and I just cut and paste from there. So it is 0.712%. Equity is 7.5%. Again, these are weighted. What do I mean by weighted? Remember, the equity is 61 million over 78, and the debt is 17 over 78. So there is a much, much higher component of equity in this example. So weighted average cost of capital will be adding those two up, 0.712 and 7.5%. So the weighted average cost of capital for this example would be 8.22%. So now we can kind of bring it back to the economic value added, right? So economic value added is ROIC minus weighted average cost of capital. So ROIC measures how effectively a company is returning EBIT or operating profit as a percent of total assets, less accounts payable or any other non-interest bearing like, accounts, accrued expenses. Weighted average cost of capital is how much is costing them company the money to get money from investors and debt holders, and from there we can do this stuff. So if for example, let's say a company was generating 20% return on invested capital, ROIC, and the weighted average cost of capital was 10%. This would be an example that the company is creating value. They're generating more return versus what they have to provide their investors and the debt holders. So that would basically, this would be what the company should be striving to do. Now, if we take and look at a little bit more, from there we can also calculate what is called economic value added in dollars. How do you do that? You look at the difference between the ROIC and the WACC, which are the 2%, multiply their invested capital, which we talked about how to do that. If the ROIC is less, which means it was the other way around, ROIC would be lower and the weighted average cost was higher, the number in the parentheses will be negative, and that will be, obviously loss of economic value. So the basic is ROIC greater than WACC, there is added value, it's about the same, there is no added value. If it is less, then there is a negative economic value added. The management team needs to focus on making sure that in the long run or along the way that the ROIC is higher than WACC. So the example we just did, the calculation I was doing, what would that have yielded? We know we calculated the ROIC was 7.12%. Then I calculated the WACC, which was 8.22%. If I do ROIC minus WACC, I get a negative 1.8%, which means what? That the company is costing them more to get the money to invest than they're generating themselves, and that is not a good thing. So the ROIC is negative 1.10%. Now, economic value added, we take this number, which is in this case is negative 1.1%, and times invested capital. I guess I'm missing a C over here. Invested capital that we had, and we get a negative value of 8.56, which means in this scenario, they are not generating value. They're actually making the value go down, which is obviously not a good thing for a company. But it's also important that we also look at it more than just 1 year. So, for example, if I was looking at 4 or 5 years, I would look at both the ROIC. In this example that I'm showing you, the first 3 years ROIC is lower, and the WACC is higher. In the 4th year, obviously, in this example, then finally the company gets their act together, and they're performing much better than what is costing them. So if I look at the EVA, which is basically the difference between ROIC and WACC times invested capital, negative, obviously, negative. Why? Because the weighted average cost of capital is much higher than what the company is generating, except for year 4, so we get a positive value. So EVA basically it quantifies it in the dollar value by looking at the difference between the return on invested capital and weighted average cost of capital. So